$12 million. Now, for our hypothetical high net worth couple today, this isn't some crazy lottery jackpot, and it's not a successful business exit. It's actually the staggering federal estate tax bill that is quietly waiting to devour their family's wealth in 2026. Because, as we all know, the tax man is always waiting.
Welcome to today's explainer, the $10 million ILIT Masterclass. Today, we're diving into a highly targeted, step-by-step narrative on exactly how affluent families are systematically neutralizing massive tax liabilities, and they're doing it using a very specific wealth transfer vehicle. So, if you've got a high net worth, you're definitely going to want to grab a notepad for this one. Section 1. The $12 million tax problem.
Okay, let's meet our case study protagonists. We've got a married couple who are staring down the barrel of a severe liquidity crisis. Right now, their total estate value sits at $60 million. But here's the catch. In 2026, the combined lifetime exemption limit drops to effectively $30 million. And that leaves a massive taxable amount of $30 million completely exposed. If you hit that with a 40% federal estate tax, the result is a devastating $12 million tax bill. Literally, without liquid cash on hand to pay that, their heirs could be forced to do a total fire sale of family businesses or real estate just to cover the tab.
Section 2. The step-by-step strategy. So what's the fix? Well, the mechanical solution to this crisis relies on a highly specialized vehicle known as the Irrevocable Life Insurance Trust, which is commonly referred to as an ILIT. The core objective here is simple, but it's aggressive. We want to permanently remove $10 million in liquid cash from their taxable estate today, specifically to cover that massive tax bill tomorrow. And the absolute secret to this is something called seed funding. We aren't talking about your standard annual gifts of a few $1,000s here. No, this is a massive lump sum funding maneuver that uses their lifetime gift tax exemption to shield the entire transfer from immediate taxes.
The really crucial part is how this actually flows in the real world. Let's break it down. Step 1. You establish the ILIT with an attorney and appoint a corporate trustee. Step 2. The couple makes a massive $10 million lump sum cash gift directly into that trust in a single day. Step 3. Their CPA files IRS Form 709 to apply this against their lifetime exemption, which means zero out-of-pocket gift tax today. Step 4. The trustee uses that cash to purchase a single premium second-to-die life insurance policy. That just means it pays out only after both spouses have passed away. And finally, Step 5. Upon that second passing, the policy secures a guaranteed $50 million compounded, completely tax-free payout to the ILIT. This distributes liquid cash to perfectly cover that IRS bill.
Now you might be wondering, why not just use the standard annual gifting method? Well, comparing the two reveals some pretty stark differences. The traditional annual gifting method carries a really high administrative burden. You have to send these legal things called crummy notices every single year, officially offering your heirs the temporary right to withdraw the cash. Plus, if your cash flow ever stops, the policy could fail due to premium lapse risk. Conversely, this lump sum funding method is a one-and-done powerhouse. It has a super low admin burden and literally zero premium risk because the whole policy is fully paid on day one. It creates unparalleled, absolute certainty.
Section 3. Blind spots and real risks.
Now, let's be real for a second. You simply cannot execute a strategy of this magnitude without understanding the very real trade-offs involved. First up is irrevocability. Once that $10 million is moved into the ILIT, it is gone. You absolutely cannot take it back. Second is exemption reduction. Using $10 million of your exemption today means you leave yourself with less to shield your other assets later on. And third, you really have to watch out for the MEC rules. Funding a policy with a massive lump sum like this typically turns it into a modified endowment contract. So while the death benefit remains completely tax-free, any lifetime loans or withdrawals are taxed as regular income, and they actually carry a 10% penalty before age 59.5. This structure is designed strictly for your legacy, guys. It is not a personal piggy bank.
Section 4. Architects of the strategy. Obviously, the mechanical structure of a massive trust like this is only as reliable as the hands that design it. Which brings us to the sponsor of today's explainer, Harbor Light Wealth and Retirement Strategies. Look, if your estate is sitting in the crosshairs of these changing tax laws, you need specialized expertise. Harbor Light brings over 25 years of experience to the table. They are anchored by elite credentials like the FIAC and FIICF designations, and they're actually qualifying members of the $1 Million Roundtable. Based out of Massachusetts, they specialize heavily in creating annuity shields and these exact leveraged ILITs we're talking about today. You can head over to harborlightretirement.com or just give them a call directly to schedule a private analysis.
Because let's be clear, an ILIT is not a DIY instrument. It's not some template you just download online.
Harbor Light acts as the central architect to orchestrate an elite team for you. You need a financial professional to structurally model the leverage. You need a specialized estate attorney to draft the trust language perfectly to satisfy federal tax codes. And you need a CPA to file Form 709 flawlessly. By acting as that central hub, Harbor Light saves families from absolutely devastating execution blind spot.
Section 5. The Macro Math Truth.
Okay, so a massive objection we hear literally all the time is, what happens if politicians in Congress just change the tax limits? Well, we remain strictly impartial about politics here because the truth is, regardless of what Washington does, the math works. Let's look at scenario 1. Exemption limits decrease as scheduled. In this case, your estate tax exposure instantly expands, and this ILIT strategy becomes an absolute necessity for liquidity. But what about scenario 2, where exemption limits stay high? Well, even if Congress permanently raises the limits, the strategy still wins. It still provides unbeatable wealth compounding, safely transferring your assets in a highly protected wrapper.
Because really, the core of this strategy hinges on one contractual multiplier, 5 to 1. By leveraging this lump sum ILIT, you are turning $10 million into a guaranteed $50 million payout. This move completely removes that seed money, and 100% of its future growth, by the way, from the friction of income taxes, lawsuits, and probate. You simply cannot replicate that level of multi-generational certainty playing in the equities market.
Section 6. The freedom to give.
You know, beyond all the staggering math, there's a really profound human element to this strategy. It's about the freedom of radically generous living. So often, affluent individuals kind of hoard their remaining wealth out of a quiet fear that if they give too much away, they might compromise their children's inheritance. This ILIT strategy completely cures that financial anxiety. Because that single premium has already contractually guaranteed a $50 million payout for their heirs, the grantors are instantly liberated. They can comfortably and joyfully write multi-million-dollar checks to their favorite charities while they are still alive. They literally get to sit in the front row and actually witness the impact of their wealth in the world.
It just completely changes the paradigm from stressful preservation to absolute joyful freedom, which leaves us with a pretty provocative question. With your family's legacy contractually secured today, what will you fund tomorrow? Thank you so much for joining me for this explainer. I really hope this deep dive into the $10 million ILIT strategy empowers you to optimize your own wealth transfer. See you next time.